Welcome back to the MD Investor channel, the channel where we talk about personal finance, setting goals, making goals, getting financially intelligent, breaking the cycle of generational poverty. We can find us on YouTube at MD Investor. Definitely hit the subscribe button, hit the notification so you'll be notified when new content comes out. On Instagram at MD Investor 1. Send the link to family, friends, let them know that we're talking about personal finance, talking about actionable material to change the course of our financial life. Today's video, guys, is going to be about the traditional IRA. Quick video. The traditional IRA basically stands for Individual Retirement Account. Individual retirement account. Only one individual owns an IRA. Even if they're married. Husband can have his own IRA. Wife can have her own IRA. They can't have a joint IRA. So it's for an individual, and it's for retirement, as the name suggests. And it's not an investment. It's basically an account. That's what the A stands for, Individual Retirement Account. It's an account that's given special treatment by the IRS. And the treatment is given is that money that you're contributing to the traditional IRA is not taxed initially. So the contributions are not taxed initially. They're allowed to grow and grow and grow and gain, and then you're taxed when you take them out at retirement. Okay? So that's actually to be compared to the Roth IRA, which I'll do a video on that. But a Roth IRA, you pay the taxes up front. You get no tax deduction for that. And the gains and the withdrawals are tax free. But today's video is about the traditional IRA, where we make contributions that are tax deferred. The account grows, and then on withdrawal, we pay the taxes. Let's do a quick example. Say you're making $4,000 a month. Take gross, $4,000 a month. Stuff gets taken out, Medicare, Medicaid, Social Security, and you might end up with maybe $2,800. So you thought with $4,000, you end up with $2,800. That's what happens normally. With the traditional IRA, you make your $4,000 gross. Say you're contributing $500 per month to your traditional IRA. So from your $4,000, you contribute your $500 to your traditional IRA. What's left is $3,500. They would only have you pay tax on the $3,500. The contribution of the $500 is tax deferred. You don't pay tax on that contribution of that $500. So that's one of the hallmarks of the traditional IRA. You don't pay tax initially. You get a tax deferred or tax deferral on the contribution. You'll pay tax later on at retirement. Okay? You can make contributions to a traditional IRA as long as you have taxable earnings up until the age of 70 and a half. Let me say that again. You can make contributions to a traditional IRA up until the age of 70 and a half, as long as you have taxable earnings. Okay? The contribution limit for 2019 is $6,000. Contribution limit for 2019 is $6,000, which had been increased from $5,500. That was the limit last year in 2018. So the contribution limit has now been increased to $6,000, and there's an additional $1,000 catch-up contribution for people age 50 and above. So if you're 50 and above, you can contribute $7,000. If you're 49 and below, you can contribute $6,000. Okay? Now let's talk about some of the penalties. If you withdraw money from your traditional IRA before the age of 59 and a half, you can be hit with a 10% early withdrawal penalty. Plus, you still have to pay the taxes because you are below 59 and a half. Let me repeat that again. In your traditional IRA, if you withdraw money before age of 59 and a half, you'll be hit with a 10% penalty, plus you still have to pay taxes on that money. Let's do a quick example. So say you withdraw $10,000 from your traditional IRA and you are below 59 and a half. You taking the money out, $10,000. So the 10% penalty would be 10% of what you withdrew. You withdrew $10,000. 10% of $10,000 is $1,000. So you're going to have a $1,000 or 10% penalty, and you still have to pay taxes on that 10%, on that $10,000 at your marginal tax rate. So if you're in a 25% tax bracket, you're going to pay $2,500 tax plus the $1,000 or 10% early withdrawal. So you see, it can become costly, and that's done as a disincentive for you to take money out. Right? The government is giving you a tax incentive to let that money sit and grow, and you're going to go ahead and take it out. You're going to be penalized. There are certain exceptions, and I wrote a few exceptions down here, where you can take the money out without the 10% penalty. Some of the exceptions are for college, for a first-time home purchase, for medical expenses, death, maybe for funeral arrangements and so forth, disability, and for health insurance due to a period of unemployment. So maybe you lost your job and you are worried about losing your health insurance, and you want to take some money out to pay the health premium. Those are exempt from the 10% penalty, but you still have to pay the taxes on it. Okay? And like I said, the government is doing this to encourage you to save and invest for the future. Now, let's talk about something called RMDs, or required minimum distribution. After you've been saving, say you've been saving, contributing all these years, and now you get to 70 and a half. One of the mandates is that for the traditional IRA, you cannot contribute after age 70 and a half. That's to be compared with the Roth IRA, where there's no age limit. You can contribute to a Roth IRA as long as you have earned income. But in the traditional IRA, at age 70 and a half, you can make no more contributions. You now have to start making withdrawals. Because think about it, all these years, the government has given you a break, essentially, right? They give you tax deferment. They've left you alone. They have not collected any tax, and they've let that money grow all these years and decades. Now they say, listen, it's time to pay the piper. So no more contributions after age 7 and a half, and now you got to start taking out mandatory withdrawal. They're called RMDs, or required minimum distributions. No question that you have to take them out. I don't need the money. You're 7 and a half. You got to take it out. That's one of the downside of the traditional IRA. So now you got to start taking this money out, and when you take the money out, now you're going to start paying taxes. Okay. So let's say, for example, you have a traditional IRA for $100,000, and say your RMD is maybe $1,000 a month. You're going to take out that $1,000. They'll charge you taxes, and that's how it goes. Okay. Required minimum distribution. That's to be compared with the Roth IRA, where there is no RMD, there is no required minimum distribution. Okay? Now, let's talk about the contribution deadline. So you have until April 15th of the following year to make contributions to the traditional IRA for the preceding year. So use 2019, for example. You have until April 15th of 2020 to make contributions to your traditional IRA. So December 31st is not the end for you. So if December 31st comes and you really have not maxed out your contributions, you still have until April 15th to really get that money in there to start that compounding, okay? So April 15th of the following year is the deadline to make contributions. And like I said before, guys, these are special accounts given special tax treatment. So when you say to someone, I have an IRA, you're not telling them what type of investments you have. You're telling them the type of account you have and how the IRS is going to treat it. And what can you have in an IRA, in a traditional IRA? Like I said, it's a basket. Think of it like a basket. In this basket, you can have stocks of individual companies, dividend stocks or growth stocks. You can have bonds. You can have ETF or exchange traded funds. You can have mutual funds. You could have real estate. You can have a lot of different things in your traditional IRA. Okay? You could have a lot of different things in your traditional IRA. So, couple dates or ages to remember, guys. Age 59 and a half is the age where you cannot take money out before that, with a few exceptions that we mentioned: health, medical, college, and so on. Without those, except for those exceptions, if you start taking out money before age 59 and a half, you're gonna be hit with a 10% penalty, and you got to pay the tax. Another age to remember is age 70 and a half. After age 70 and a half, you cannot contribute anymore to a traditional IRA. You have to start taking money out, what they call required minimum distribution, and then you have to start paying taxes. The IRA is basically a basket. It's a special account. It doesn't tell you what's in it, okay? You can put garbage in there. Like we talk about, you can put actively managed account with high expense ratios, which is garbage. Or you can put good stuff in there, okay? Like index funds. You can put dividend growth stocks in there, ETFs, and so on, okay? So there's a quick video, guys, about IRAs and the utility that we can use to grow our net worth. Okay, so continue to like, share, subscribe. Anyone out there you think could benefit from this personal information, let them know. MD Investor on Instagram, MD Investor One, guys, and we're gonna see you on the next video.